Okay, so in this video, we begin our trek through ARC Section 90A, which is specific to the review of financial statements under SARS. And it's promulgated in SARS numbers 21 and 23, and it's effective for reviews of financial statements for periods ending on or after December 15, 2015. And so for this video, we'll just sort of go through an introduction and a scope of this ARC Section 90A and how it applies to our engagements. So quite simply, this ARC Section 90A applies when the accountant is engaged to perform a review of financial statements. And it also applies when we're engaged to review other historical financial information. But importantly, this excludes pro forma financial information, so financial information that is not historical or does not follow a financial reporting framework. And therefore, pro forma financial information falls under the standards of the Statements on Standards for Attestation Engagements. This section also does not apply when the accountant is engaged to review interim financial information when that entity's latest annual financial statements have been audited by the accountant or a predecessor. So, for example, for publicly traded companies, they're required to be reviewed quarterly, and so that would be interim financial information where they've been audited on an annual basis. And actually, these types of reviews fall under the AUC sections for audits, as it says here, AUC Section 930. So those types of reviews do not fall under ARC Section 90A here. And so the objective of performing a financial statement review under ARC Section 90A is to obtain limited assurance as a basis for reporting whether the accountant is aware of any material modifications that should be made to the financial statements for them to be in accordance with the applicable financial reporting framework, primarily through the performance of inquiry and analytical procedures. And so throughout the next several videos, we will go through the requirements that the section suggests in order for us to meet this objective here, and we'll have more understanding over what each of these terms means and how much of assurance, limited assurance, means. So we have a lot of reference paragraphs here, A4 through A9, as well as 1 through 3. So let's take a look at A1 through 9 to get some more understanding on the scope and applicability of ARC Section 90A. Okay, so now we're down in the other explanatory material as it relates to the scope and applicability of ARC Section 90A. And so if we remember, it said that whenever this ARC Section 90A applies to a review of other historical financial information as well, other than financial statements. And so they make note that when we're going through these sections in the next several videos, if they say financial statements, that also refers to other historical information that we might be reviewing. So when they say financial statements, it's not limited to financial statements. They also mean other historical financial information. Just for brevity, they've just said financial statements throughout the section. And so some examples of what they mean by other historical financial information might include specified elements, accounts, or items of a financial statement. For instance, different schedules, maybe of rentals, royalties, profit, participation, or provision for income taxes. It also might include supplementary information, required supplementary information, or financial information contained in a tax return. So in future videos, we'll go through the reviews of these types of other historical financial information. And another item that we might perform a review, which is not all financial statements, is we might review a single financial statement, for instance, just a balance sheet, and not the other financial statements, for instance, income, retained earnings, and cash flows. And the only way we're able to do that is if our scope of our procedures are not restricted. Therefore, some of our procedures might include income statement accounts, and whenever we are performing some analytics or inquiries of the balance sheet. And that makes sense because a lot of balance sheet accounts are related to income statement accounts. For instance, depreciation would affect the accumulated depreciation in the fixed assets and so on and so forth. So if our procedures are restricted, then we may not be able to get comfort over the balance sheet itself. So we need to keep that in mind. Going forward to the objective, it gives us some more color on what we're trying to achieve and how that might relate to an audit. So in an audit, we are obtaining reasonable assurance, which is a high but not absolute level assurance that the financial statements are free of material misstatement. And that's different from the wording of what we saw in the objective of a review, which said that we obtain limited assurance that no modifications need to be made to the financial statements. So very different use of language there. Also in a review, we don't necessarily have to obtain an understanding of the entity's internal control as we would in an audit. We don't have to assess fraud risk. We don't have to test accounting records by obtaining sufficient appropriate audit evidence to inspection, observation, confirmation, or examination of source documents or other procedures ordinarily performed in an audit. So in that sense, in a review, we may obtain schedules that support the line item on the financial statements, but we don't necessarily confirm or observe or inspect that that schedule is accurate by performing or by looking at source documents or other means. And we also don't really consider their internal control or fraud risk as we would in an audit. And therefore we don't obtain assurance that would make us aware of all significant matters that would be disclosed in an audit. However, a review is designed to obtain only limited assurance as a basis for reporting whether we are aware of any material modifications that should be made to the financial statements in order for the financial statements to be in accordance with applicable financial reporting framework. And as we go through subsequent videos, we will go through all of the requirements and the procedures and steps that we need to do to achieve that limited assurance. Next, we have materiality. As in an audit, we also have considerations for materiality, and it's made in context of the applicable financial reporting framework. And so misstatements, including omissions, are considered to be material if they individually or in the aggregate could reasonably be expected to influence economic decisions of users taken on the basis of the financial statement. So notice that this doesn't give us a quantity. There could also be a quality basis in what might be considered material to a user of a financial statement if he had known about the misstatement, or if that account balance or disclosure had been different. And that's described here where it says that judgments about materiality are made in light of the size or nature of the misstatement. So not only the quantity, but the quality of the misstatement as well. And this also specifies that materiality should be considered in relation to the users as a group. It would be pretty inefficient to develop a materiality for each individual user of the financial statement. So it specifies here that we can look at materiality for the users as a group. For example, one user might be concerned with the net income, and another user might be concerned with the value of real estate on the books or something like that. So if we were to have to build an individual materiality for each of those different accounts for each of those individual users, it would take up all of our time in the audit pretty much. So they waive our requirement to have to do that there. And so they make note here that if the financial reporting framework discusses materiality, then we might use that discussion as our basis for materiality. But if not, we can use A6, which we just discussed, as our consideration of materiality for our frame of reference. Also, paragraph .28 in ARC section 90A discusses materiality, which we will get to in later videos. And so continuing on with our discussion of materiality, the materiality is a matter of professional judgment, and it's affected by our perception of the needs of the intended users of the financial statements. And so, therefore, it's reasonable for us to assume that users have a reasonable knowledge of business and economic activities and accounting, and a willingness to study the information in the financial statements. We can assume these users also understand that financial statements are prepared, presented, and reviewed to levels of materiality. And therefore, all misstatements may not have been found or adjusted away. Also, we should assume that users of the financial statements recognize uncertainties inherent in the measurement of amounts based on the use of estimates judgment and the consideration of future events. So there's a lot of estimates involved in financial reporting frameworks, so the users are aware of that. We also should assume that users make reasonable economic decisions on the basis of the information in the financial statement. So if we are basing our level of materiality on whether economic decisions would be changed by the users of the financial statements if they had known about this misstatement, then we need to consider that these users would make reasonable economic decisions. Otherwise, it would be difficult for us to predict what economic decisions that irrational users of the financial statements would make. And so to reiterate what we discussed above regarding the misstatement or the level of materiality for specific users, if we have reviewed these financial statements for a particular user or set of users, then we could develop a materiality for that specific user because he or she or the group is the only one that this review or the financial statements are intended for. But if there's a wide range of users, then their needs may vary, and it'd be impractical for us to develop a level of materiality for each specific user in that wide range of group. So instead, we develop a materiality that would be useful to all users of the financial statements. And finally, they say that our judgment about what is material in relation to the financial statements as a whole is the same regardless of the level of assurance that we got as a basis for expressing our conclusion on the financial statements. So this is saying that if we were to obtain a lot more assurance on a particular account, then we should not lower our materiality just because we obtained more assurance or were more comfortable over the balance. Our level of materiality is the same no matter what our conclusion was. And so finally, a little discussion of revising materiality. So we need to consider our level of materiality throughout the engagement, not only at the beginning, but as we're working through the engagement as well as at the end of the engagement. We're considering those statements and how material they are. So we have a few examples here of reasons we might revise our materiality. First, we might revise it for a change in circumstances that occurred during review. So, for example, if the company under review decided to dispose of a major part of its business, or if we receive new information or a change in our understanding of the entity's environment as a result of performing our review procedure. So if when we're performing our review, we find out that the financial results are substantially different than our initial materiality level that we calculated at the beginning of the engagement, then we might consider changing our materiality to fit our new understanding of the financial results. So this gives us a good starting point on the ARC Section 90A document and its relation to materiality and the scope of what we will try to accomplish in a review of financial statements. And so in the next several videos, we will go through the specific requirements of how to achieve these objectives.